Kia ora koutou and welcome to Markets, Mystics and Mayhem, a weekly podcast with Kiwibank's economics team alongside the occasional special guest. We'll delve into the data, decipher policy decisions, monitor the markets and analyse the issues impacting the Kiwi economy. Let's get into it.
Well, welcome back to the podcast. This episode, we're going to be discussing the housing market. We gave an update, I think, a few months ago before the break, and I have to say not much has really happened in the housing market since then. House prices they're trading sideways. There's still a lot of stock to clear in the market, so it's still quite a subdued housing market, but we're still hopeful that this year we'll see a turnaround in housing. We know that rate cuts are coming through and that'll fuel demand, and we also have other policy changes which should get investors particularly off the sidelines. But before we get into the forecast and look ahead, why don't we look back and actually see how things have developed in the housing market. We had a 45% gain in house prices during the pandemic, but then we had an 18% correction over the next 18 months from November 2021 to early 2023. We know that interest rates are the biggest driver for swings in the market, but there have also been some policy changes by both the government and the Reserve Bank. And I think this podcast episode will kind of make this an explainer of all these changes to kind of help you going through. Why don't we start there with the first one that comes to mind is the Brightline test. Sabrina, why don't you give us a definition as to what that is?
Yeah, so the Brightline test is essentially the closest thing we have to a capital gains tax here in New Zealand. When we first saw it implemented in New Zealand, it was put in as a 2-year time period. So if you bought a property and then sold it off again in two houses in 2 years' time, the profit that you were making on that was getting taxed. Then, later iterations, we saw that extend to the 5-year period, then all the way out to 10 years. And then most recently, it's been pulled back down to 2 years.
So let's put that in perspective. 2 years is nothing. It takes the council 2 years to reply to your email when you're trying to get something through. So 2 years does not worry investors. 5 years was kind of, a little annoying, but 10 years was when, that was obviously taken a lot more seriously by everyone involved, particularly developers. Now that it's back to 2 years, well, like I said, 2 years isn't long.
Yeah, and I should say that these changes that were made were in response to that 45% gain in house prices to try and cool down the market. So pushing it out to 10 years really took people kind of off, came off the housing market. Okay, the next one, interest deductibility on rental properties. Explain.
Yeah, so when it came on in the first place, we saw that homeowners were able to claim the interest as an expense payment. Great for investors. Then we saw that taken off, and now recently with the change in government, we've seen it put back on.
It's a big expense, right? So the interest on the mortgage on your investment property, you could deduct it. Next minute you couldn't, and then you can deduct it again. So it's definitely one of those things that had an impact on investor appetite in the market.
Yeah. Come April this year, 100% of that interest expense can be deducted now. So basically, as you're saying, investors now can pay less tax, which does improve the rental yield for investors. So again, this change should put them back into the market. The other one, CCCFA. Why don't you explain that one?
Well, look, I think if I was really explaining all of CCCFA, we'd be here all day. It's a huge policy to go into. But basically what we saw was that the affordability assessments got quite a lot stricter, and I guess there was a lot more scrutiny over people's living expenses and whether in the long term things could be really affordable. And it really saw access to credit really ramped up, made it quite a lot harder to access credit.
Yeah, CCCFA is a swear word in banking. Having to jump through all these hurdles, having the risk of something going wrong, and making a headline, really sort of scared banks, I think, and we saw them tighten up credit standards, as you say, and there were so many articles in the newspaper about banks, looking at how many coffees you're buying in a day and all this sort of stuff. So it definitely made everything a lot harder. And, what we saw after COVID, as you said, was this massive surge in property prices. They rose 45% in 18 months, and it became a real political issue as well as a monetary policy issue. And a lot of these changes were made to really rein the housing market in with a focus on the investor. Now that we've seen a change in government, a lot of these things have been reversed, like the Brightline, the interest deductibility, even a watering down in the CCCFA. But investors are still sidelined. So we've had these changes, and we've seen interest rates come off, but they're still on the sidelines. So that's the missing piece of the puzzle.
Yeah, like right now, if you look at who's active in the market, we've actually seen an unusual, more, not unusual, but first home buyers are unusually specifically more active than investors are, which is quite rare.
That is unusual.
So, but if all these changes have been made, has it just been an interest rate story that's holding back investors then?
I mean, if you talk about the housing market and what causes big shifts, it's interest rates first and foremost. And then you could argue supply-demand dynamics, which we'll probably talk about later, but these policy changes definitely exacerbate moves. So I think the policy settings, are more conducive to a market where investors will come back in and things will pick up later in the year, but we kind of have to wait and see. But interest rates falling is the big one, and that's what's going to get the housing market back up.
Yeah, and in your travels, JK, when you're speaking to households and investors, are they kind of getting excited by these changes in policy? Is this kind of like on their side now that they'll jump back into the market?
I'm hearing mixed messages, or like really mixed. People will turn to me and say, "Thanks for the optimistic view. It's nice to hear that things are going to, bounce back in the second half of the year and into next year, la-di-da." But then, I've heard from investors just turning around saying, "Well, I think the government, may change again in 2026." And that's really disheartening to hear that people are, cautious today, the start of 2025, about an election that's, late in 2026. They're worried that the government changes again and the Brightline test gets extended, interest deductibility gets ripped out. And, there could be other things that come to haunt the market again.
That is a concern because, like I say, they plan ahead. But if this is what they're kind of expecting as a scenario to develop, they could, force inaction now. And I mean, I guess that's a risk to our own outlook for house prices.
Yeah, exactly.
Cool. Okay, so that was all government policy, all those 3 changes. But the Reserve Bank also has been tinkering around with macroprudential policy. Firstly, with loan-to-value ratio restrictions, LVRs. They've loosened that. Sabrina, do you want to tell us a little bit about that?
Yeah, well, first of all, I just want to say, at least with these Reserve Bank sort of more macroprudential tools, we don't see them fluctuating with government cycles. It's more to do with how hot or how cold the housing market is running. But yeah, touching on loan-to-value ratios, I mean, first of all, defining it, it's in the name. How much are you taking as a loan relative to the amount that the property is worth? Now, how the Reserve Bank sort of implements this as a tool is by setting restrictions on bank lending to high loan to value ratios. So the actual amount has fluctuated as the market has ramped up or cooled down currently. And we also see differences in LVRs applied to homeowners versus investors. I think even at some points we've had Auckland-specific LVRs. But currently looking at the LVRs that are in place today for investors, it's banks can only give out no more than 5% to investor home loans above a 70% ratio. And then on the homeowner side, it's an 80% ratio for 20% of the new lending book.
So yeah, I guess that what that means is it's that whole speed limit that the Reserve Bank puts on low deposit lending. But yeah, so the higher the LVR, the higher the risk, and the Reserve Bank has set rules around how much at high LVR the banks can lend.
Yeah, I mean, it's worth pointing out that this is done through the lens of financial stability. You're trying to take out the riskier lending that happens in bull markets. When the housing market's really going for it, you do get riskier lending creeping into the system. We saw it in 2020, 21, had these restrictions being in place. We might not have quite seen as much money created or loans created during that period. So they're very much trying to, take out the highs and lows in the market.
Okay, so we've had all these changes to both government policy and LVR on the Reserve Bank side. The question is, does this, create another housing market boom now that these restrictions have been eased and credit conditions are a bit easier now? But our answer to that always is, now we've got debt to income ratios in place, that does kind of limit the probability of another big housing market boom. But debt to income ratio restrictions are new to the Reserve Bank's Macroprudential toolkit. Do you want to explain what that is, JK?
Yeah, so debt to income ratios, as they say, it's how much debt you can take on relative to your income, and the thoughts from the Reserve Bank is that at the moment we'll say for owner occupiers it's 6 times. So if you've got a 100,000 income, then you can go up to sort of 600,000, or that's where the speed limit starts to kick in at least. And then for investors it's 7 times. So that's about here or there. We do have these overseas in Ireland and elsewhere, so that they are tried and tested. Again, if we look at the data over that 2020-21 period, we did do a fair amount of high DTI lending, which definitely spurred on the market at the time. Had these been in place, say in 2019, I don't think we would have quite seen as much, lending taking place. At the moment, our run rate is very low, like it's well below 10%, and we've been given a 20% speed limit. So we can actually still do, quite a bit more high LVR lending before we come up against that handbrake. But it's there. If the housing market does take off again and look like it's going to get, heated, it is sitting there as a little bit of a automatic handbrake that'll get turned on, right? I have heard in my travels that there are some people bumping up against it already. So they've probably been allowed loans because the speed limit's so low at the moment. But it is interesting to hear that it is something that people are aware of, or at least talking to their bank about.
Yeah, I like how when this first got implemented mid last year, our answer when we were asked about this, what's DTI is going to mean, and it was a really easy answer: nothing right now, because we're not lending at that 20% sort of speed limit. Yeah. So how soon, and as you say, the data isn't showing that we're nearing that yet, but how soon obviously depends on the housing market and the recovery. But I guess based on our forecast as well, how soon will it be before we actually see maybe people in the data seeing that reach that 20% limit?
Yeah, well, firstly, to explain to listeners, is banks are not going to go near that 20% limit. You do not want to hit that 20% limit and a trigger go off and the Reserve Bank give you a call. You're going to run at, say, 18%, just so in case there's any spikes in your lending that you're unaware of. So you're going to take it really conservatively. Banks do that with these speed limits. But we're nowhere near there. I mean, on some of the data, we're running at like 6-7%. So there's plenty of room for us to pick up. And I think that's the story for the second half of this year. As we recover, we might see more and more people bumping into this DTI restriction. So sort of watch this space, something that could potentially restrain growth, but we've got to get that growth first. And there's still there's more supply of credit, in my opinion, than there is demand for it at the moment. I think banks are pretty keen to lend, but it's the household, it's the business, it's the investor that don't quite have the appetite yet. We've been through a recession. It takes a while for appetites and confidence to properly return.
Yeah, that and there's still this forecast rise in unemployment that could be holding people back and making these decisions as well. That's another big headwind for our forecast of house prices this
Well,
year.
just because that feeds into insecurity, right? If you know the unemployment rate's rising and you see or you're part of a business that is still scaling back, I mean, there are many businesses still cutting hours, still cutting heads. That insecurity in your own, job, you're not going to go out and buy a house, are you? You're just going to sort of wait it through until you're confident yourself. So again, it's the second half of this year's story, isn't it?
Yeah, I think that's really the story or the narrative for most of these variables we're looking at, whether it's house prices or, GDP growth and all that. It's the second half of the year type story.
So in that case, we are picking a recovery in the housing market. Is, our 5 to 6, 7% still our best pick then?
It is, yeah. I think, again, we're hopeful that the recovery takes place. Interest rates, as we've said, is the biggest driver here, and we've already had a few interest rate cuts, and we've got a few more to come this year. So retail rates still have a bit more to fall, and that should see investors and just households just look into the housing market with a bit more favour. They could be building up equity in their own property right now, just waiting for house prices to kind of lift before they jump in with another decision. But I think this year we still are seeing that 5 to 7% gain, which isn't necessarily shooting the lights out, but it is better than what we've seen over the last few years.
Yeah, I've also heard that equity story as well, just households wanting to rebuild a bit of savings, rebuild their equity a little bit, and equity, lifts quite quickly with house prices rise. People are still kind of waiting, and I've heard from investors that their equity's been hit across their portfolio, so they're sitting there waiting for things to improve as well, which just sort of elongates the recovery. I think I would go as far as to say, look, what we've talked about is we've had some fiscal policies, whether it's the Brightline, whether it's interest deductibility, CCCFA coming on, coming off, which is helpful. And then you've had these macroprudential measures, LVRs being, stronger than they were, easing back a little bit, which is helpful. But then we've got the DTIs as almost like a counterweight going forward. We've talked about interest rates being the key driver of the housing market, and it is. All of this points to a recovery later in the year, but I do think that we must highlight the demand-supply dynamic in the market. New Zealand has a chronic shortage of affordable housing, and to me that can exacerbate ups and downs, and more to the ups than the downs, I would suggest. So how are we seeing that demand-supply balance? I mean, you're all over the migration, you're all over the population side of it, and the supply side of it as well.
Yeah, well, on the supply side, it's kind of like a vicious cycle where there's been no demand in housing. So then you're seeing just no, building consents have been really weak coming off their peaks. There's just no activity in construction, residential construction in particular. So on the supply side, it's already weak, and you put that on top of an already chronic housing shortage that we face. On the demand side, we did have this big migration boom, but that kind of played through mostly in the rental market, actually. I think that was, if you kind of look at the demographics of who came, was more a younger cohort, so they're kind of going into the rental space, and it's part of the reason why we saw rents climb to their highest, but less so in the housing market space. I don't think they're going out to buy a house just yet. But, you know, our population, people are still coming into New Zealand. Our net migration has fallen off mostly because people are leaving New Zealand. But there are still people coming into New Zealand, and that will put just naturally some upside pressure on house prices. So that supply-demand imbalance is kind of going towards that chronic housing shortage, which is, I guess, just naturally speaking, a tailwind for the housing market.
Yeah, it's definitely a pillar of support. You know, I was looking at the data, you know, a little while ago, year or so ago, and you were right. You know, the migrants came, they were young, they rented a room or rented a house rather than bought. So we saw the pickup in rents, and I saw rents going like this and house prices going like this, and I thought investors, you know, that's a pickup in rental yield. So, you know, are they going to be attracted back to the market? Answer is no, not yet, right?
Yeah, and I guess it's because that interest deductibility still being in place, which would hold them back, right? But again, people are still coming through, and now the interest deductibility has been removed, and there is this hunt for yield, especially with interest rates on the deposit side falling. So another tailwind for investors to come back in.
Just need to see interest rates lower, so those rental yields kind of outshine, look much better.
Although now I know you mentioned net migration, it's still running positive, but the main story we're hearing is just the brain drain and all the Kiwis leaving New Zealand. Do we think that also now poses risk that actually rental yields, they are coming off their peaks, and maybe there's more room for them to fall further from here and then not attract investors as much?
Well, the rents, the growth in rents, what did it peak at? 3.5%, 4%, something like that?
Higher.
4.5%. I mean, that's quite high. Like you're right though, that migration boom's coming off, so those rental growth rates are coming off.
Yeah, I guess, it's just, I guess on the interest rates, they're falling as the Reserve Bank cuts the cash rate. It is a blunt instrument, so deposit rates are falling. But yeah, I think that slowdown in net migration is mostly because people are leaving. There's still people coming, and I think it's still running at above pre-pandemic levels. So there's still going to be demand for rental spaces.
What did you say about the process last week? I liked that. I stole it elsewhere.
To trust the process?
I like it. I reckon it's a really good way of talking about these things, right?
Yeah.
The process is what? Cutting interest rates. What have we got to trust? We just got to trust that lower interest rates will feed through into activity. You know, it might take 3 months, might take a year, but you know, we are trusting the process.
Yeah. And we've seen this is just how monetary policy operates, and if you trusted it, if you look back and see how it worked before, it's going to work again.
Yeah. Hold on, wait a minute. Does that mean we blindly trust the RBNZ? No.
We blindly trust economics. Cool. I think we'll leave it there. Hopefully this was a helpful episode, just kind of going through all the property policy and what's affecting the market there. But yeah, if you like this episode, please like it, subscribe, follow, all that good stuff. See you next week.
You've been tuned into This is Kiwi Economics, Markets, Mystics and Mayhem. We'll be back next week for more analysis and insights.